Ladies and gentlemen, welcome back to the channel. Here in this video, we will be going over why I think Tesla stock is about to go through a pretty crazy year-end rally and have an even better 2026. Okay. I think Tesla stock by December 31st could be $500 a share or higher. And part of this is the same thesis I've had for a while, but part of this is what we've seen on Friday with the jobs report. Wall Street is clearly not concerned about recession. If the Russell was the outperforming index and Nvidia sold off and Microsoft sold off, this is a clear green flag for equities, specifically for risk-on equities like Tesla. Now, Tesla did very well on Friday as well. This has to do with Elon Musk's compensation package. And it's really going to set Tesla up for a very strong end of the year rally, especially as we get better than expected news on robotaxi, faster deployment of robotaxi, and I believe this demand explosion we've seen in Q3 that leads into Q4. So in this video, it's really going to be split up into two different segments. Because again, what happens in the broader markets, the dynamic that we're going to see in markets into the end of this year and 2026 feeds directly into Tesla stock. Okay? If the markets crash, Tesla's not going to go up. If the markets go up a lot, Tesla's probably not going to crash, right? There is a very strong relationship between high beta stocks like Tesla and the broader markets. So if I think Tesla's going to do well into the end of this year, really well, then that means I think the markets are likely to do very well. Also, you almost can't have one without the other. Okay? Unless we get like a very strong market rally and we start to get some bad news for Tesla, then that would obviously be a disappointer. But I think Tesla could go up over 42% into the end of this year, but not really in September. Okay, I'm focusing more from like mid-October through November and December. I think it could be one of the strongest 2.5-3 month periods we've seen for stocks in a very long time. Ladies and gentlemen, the work is cut out for us here in this video. Hit that like button as well as subscribe to the channel if you have not done so already. It's free 99. It costs you absolutely nothing to do so. If you want to come join the trading community, the best trading group in the world, here in the right time, in the right field, check it out. Link down below in the description of this video. We are going out finding high quality AI stocks, not shit companies, high quality companies that Wall Street doesn't know about yet. Okay, there's some very exciting opportunities over there, and I believe what is a once in a lifetime opportunity. Come check it out. Link down below in the description of this video. But let's get into today's episode. What we seen on Friday, I think, was incredible. Yeah, the jobs report came in bad, really bad. 22,000 jobs. We were expecting 75,000 jobs. Unemployment rate hit the highest level since 2021 at over 4.3%. But what you actually seen was a rotation, more or less. If you look at the S&P, you were down about 1/3 of 1%, down 0.2% in after hours. Look at Nvidia, down 3%. Amazon down 1%. Microsoft down 3%. Other big tech stocks down as well. But what did we have? IWM was up 0.5 of 1%. So as I've talked about on this channel before, not all rate cuts are equal, right? If you get rate cuts because the economy sucks, the labor market sucks, that should not be taken as good news. But it was. We got a bad jobs report and it was taken as good news for small caps. Yes, that means more cuts, but potentially cuts not for the right reason. What I got out of Friday is the stock market is really not concerned about going into a recession. Now, why is that important? Okay, that is important because, yes, we're in a weak September seasonal period, okay? But big money positions ahead of time. So big money is going to position for a recession, or they're going to position for, markets to do well ahead of time, right? They're always the first ones to the party every single time. And this jobs report on Friday, well, it looks bad. Wall Street says, that's not bad. That's not recession. Thus, seen small caps go up. The benefit from rate cuts was not offset by a weak jobs report. In the month of September, when seasonals are bad, you would have expected the Russell to do really bad on Friday based on the jobs report. And again, that did not happen. So I'm kind of tying this into my broader theory on why from really middle of October, November, and December could be one of the strongest 2.5, 3-month periods we've seen in the stock market in a very long time. Okay, let me break it down for you if this is the first time you've heard it. Okay, we should have inflation that continues to trend lower, trade deals done. Now there's the whole court litigation, so it's going to make things a little bit weird if the courts rule against Trump. But overall, by December 31st, we should have a lot of clarity on what trade is going to look like. Okay, geopolitical tensions that die down. The provisions in the big, beautiful bill are very bullish. No tax on tips, no tax on overtime, being able to write off different things on your taxes like interest on vehicles, so on and so forth. That should help the consumer recover a little bit. Like 2026 tax season should be pretty damn good for folks. Okay? Like if you get $25,000 in tax income, and you consider a federal tax rate around 20%, you're going to save $5,000 on that. Like you should theoretically get like $5,000 extra dollars on your tax return. That's a lot, okay? If my numbers are correct. If they're not correct, correct me down below in the comment section. But you should be getting a substantial tax return back. So 2026 should be a pretty good year for the consumer. Hopefully they can start to recover a little bit. Now, Wall Street, they price things in ahead of time. So the last 3 months of this year, we're going to be starting to price in some of that good 2026. Now, fact of the matter is we just got done with the best earnings season we have had in years. Okay, earnings were very strong. And the fact of the matter is earnings do not collapse for no reason. Right? If earnings came in this good for Q2, even though, you had trade and tariffs and all of that, it's very unlikely that earnings collapse anytime soon. Okay? It's just very unlikely. Okay? So that's a strong sign for the economy as well, because earnings are mainly tied to the economy. Sure, you have big tech that's not as correlated to the economy, but broadly speaking, earnings are correlated to the economy. The better the earnings, the better the economy. The better the economy, the better the earnings, right? That's why stocks, if you didn't know, react so much on economic data, because it directly correlates with earnings. Now, we also have one of the big sleeper catalysts next year, and I'm calling it a sleeper catalyst because nobody really talks about this, but it's real estate. Okay. So for an example, I purchased this home that I'm in right now in Michigan in March of 2021. Perfect timing, right? Like timing couldn't have been better. And yes, I own 2 other rental properties. Okay. It's not my first rodeo, but again, perfect timing. I bought this home without even looking at it. Didn't know if I was going to live in it, but knew the price was right at about $72,000. Okay. Guess what this home is worth today? Yeah, I've painted, I've put in luxury vinyl plank, I've redid the cabinets, I've done the trim, I've done some cosmetic shit. Okay. $2,000. Guess what this house is worth? I could list it today around 200 to 220,000. Okay. If I wanted to sell it quickly, or if, as I expect will happen in 2026, more inventory comes online and it's more of a buyer's market, I could probably sell it for like 180. Okay. If price comes down a little bit. Owing about 60,000. Could net anywhere between 130,000 and 180,000 or so, 170,000 or so. If I was the average person and just could sell a home, get a new home, and have over $100,000 in the bank, people are going to spend that money. Okay. But this home, when I bought it, its mortgage was $500 a month. Today, after taxes and all of that going up, it's about $800 a month. So, like, yeah, mortgages have definitely went up. Okay. But if I wanted to get this house today at 180 grand, 200 grand, it's going to be like $2,000 a month. The average person cannot afford that kind of a payment, right? So that's why people are not selling their home. Okay. And that's why they can't realize that equity. Sure, could you go to the bank? Of course, but a lot of people don't want to do that, or don't even know that that exists, that you can tap into home equity fairly easy. Okay. So people are going to get a lot of money once they can start to sell their homes and buy new homes for reasonable prices. And that is going to unlock another level of the consumer recovering. All while at the same time, in 2026, inflation is coming down, consumers getting better, corporate tax structure is much better than what we could have imagined, especially being able to depreciate capital expenditures. Like if you're a farmer, you can go buy a new tractor and write off 100% of it. You can build an AI data center and write off 100% of that. You know why Amazon didn't pay taxes at all for like 20 years? Because they had so many losses and so much that they could write off year after year after year. Well, think about that now on steroids, essentially. Like, yes, it could actually encourage quite a bit of frothy behaviors, even in the corporate world. That's not a problem until it is. We'll be watching for that. And that's one reason why I think next year we could have a euphoric market, not a bubble, but a euphoric market where good companies are rewarded more than you would expect. Hence why I think right now is a great time to be in the trading community. Well, we could start talking about a bubble towards 2027 or 2028 if the markets just go crazy next year, which I think has a fairly good shot of happening. So when I put all of this together, it's hard to be bearish. Okay. Now September again has some weird seasonals, but all of these things that I'm talking about really for 2026 will start to be priced in towards the end of this year, as the markets are a forward pricing in or forward discounting mechanism of future returns or future growth. We could be setting up for a pretty damn parabolic rally into the end of this year. And I don't think a lot of Wall Street is prepared for this, right? As we look at the AI Investor Sentiment Survey, 43.4% of investors are bearish, 23.9% are neutral, and 32.7% are bullish. There's a lot of bears out there. CNN's Fear and Greed Index, even as the S&P hit a briefly new all-time high on Friday, you're coming in at 53, which is neutral. You're not even close to being overbought or overextended here. Market momentum is neutral. Stock price strength, extreme greed. This is very important. Net new 52-week highs and lows on the New York Stock Exchange. So at the same time, I don't think I've ever seen this before. The headline number is neutral at 53. Stock price strength, extreme greed. Stock price breadth is greed. Put and call options, greed. But those two metrics are telling you like, hey, something is driving down the index or keeping people bearish, which is likely Trump. And the uncertainty and aggressiveness that things can change from Trump. But really under the surface, markets look fine. That's what these two metrics, stock price breadth and stock price strength, are telling you. It's pretty incredible. Market volatility is neutral. Safe haven demand is fear. You can also see this if you look at the percent of stocks trading above their 50-day moving average at 63.2%. It actually went up on Friday. So even though we had a bad jobs report, even though we're in the month of September, and I would have expected stocks to have a bad trading day. I actually said on Thursday that if we came in with a jobs report under 50,000, it was probably going to be seen as a negative. Okay. In fact, the June jobs numbers were revised to negative 13,000. Like, I wouldn't have expected the Russell to go up 0.5% because the Russell is very sensitive to, yes, interest rates, clearly, but recessions, right? So if the markets were really fearful about a recession, which, keep in mind, big money moves markets. It's not retail, it's big money, okay? If big money was really fearful that a recession was coming, the Russell would have been down a lot. And rate cut odds, yes, they skyrocketed on Friday, but it doesn't seem like for the bad reason, or for a bad reason, right? Not the whole recession reason. So again, when I put all of this together, as long as things do not get dramatically worse with the economic data, like, we are setting up for a very strong end of this year. And again, unless something dramatically changes with, trade or something along those lines, like if a trade deal fell through with China and 150% tariffs were back on, like, you're not going to get a year-end rally. But as long as nothing crazy like that happens, I think a very strong year-end rally is coming. And I think any weakness in September is a massive opportunity, in my opinion. For Tesla stock, getting Elon's compensation package put out there was big, okay? Because from a Wall Street perspective, they look at Tesla as an auto company. In fact, Tesla's management team is striving to become the most valuable company in the world. You have to understand that Wall Street and fund managers, they're really just trying to beat the S&P. That's it. Like, Tesla is saying, over the next 10 years, we want 85% cumulative returns. Okay. We want an 850% return over the next 10 years. That's how Elon gets a massive compensation package. But even just to get the first tier unlocked, Tesla stock has to go to a $2 trillion company. That's a double from here. That is Tesla stock at $640-ish per share. I mean, that's going to put Tesla up here, okay? Just to get the first tranche unlocked, okay? And then Tesla's going to unlock another tranche at that point in like the high 700s, somewhere around there. Like, you're not looking at simplistic returns. You're talking about massive upside. And from a hedge fund institutional perspective, as well as a retail perspective, that sounds good. Okay. And retail has understood this for a while, I believe. But Wall Street has to start understanding that Tesla is at the forefront of AI, that Tesla is an AI company. Tesla is not an auto company. And I think partially heading into this year, some of the rally is going to be based on that. Wall Street having to accept that Tesla is not just a car company. Tesla is an AI company. Tesla is here to win. We're talking about 1 million Optimus bots sold, 1 million robotaxis in commercial operations. Okay? These are huge goals. And I think what's also interesting about the operational achievements is if Tesla hits the high end of those operational achievements over the next 10 years, like 400 billion in EBITDA, that's 4x Nvidia's adjusted EBITDA in the last 12 months. Tesla's probably going to be like a $20 trillion company, somewhere between 15 and 20 trillion. Like 8.5 trillion, that's the minimum. That's the literal bare minimum. if Tesla hits the highest tranche in the compensation package. So I think you almost have to look at it in that way. So again, it's a big shocker to Wall Street. And I think if we weren't in September, if we didn't have a really bad jobs report, Tesla stock would have been up over 10% on Friday. I think it was really held back a lot. Now, even put it into context, Tesla stock is trading lower today than it was just back in May, early June, when the Robotaxi network didn't even exist. Okay? So I think you could get a bit of a short squeeze as well into year end. A bit of a gamma squeeze where retail investors come back into the stock. Institutions are in the process of getting more bullish in the stock. We've already seen institutions really start to cover on short positions a lot in the past month or so, ever since Tesla's last earnings, where technically the stock is up already from last earnings around 18%. So you've already seen, some of that upside from shorts covering. But I think that's really going to continue into the end of this year. You also need to keep in mind that from an institutional perspective, for fund managers that are just trying to beat the S&P, they're underweight Tesla a lot. Meaning, if Tesla's 5% of the S&P, some funds may have 2% of their portfolio in Tesla. And the other 3% they should have in Tesla, they have that maybe allocated in Google or Microsoft or Apple or NVIDIA, right? If NVIDIA's, let's call 7% of the S&P, they're only 2% in Tesla, maybe they're 10% in NVIDIA to make up that difference that they're not in Tesla. Okay. I view Tesla as, again, you could be benchmarked to the S&P, but Tesla's also going to give you that alpha return as well during the good times, right? Tesla's going to really move your portfolio if you're a hedge fund or institution, and especially heading into lower rates, better economy, lower inflation. It should be an optimal market for Tesla's auto business, as well as expanding the AI business, which I think is going to become a lot more in focus into the end of this year as Tesla launches, more vehicles in more cities and gets more permits up and rolling for maybe Phoenix and some cities in Florida and maybe Chicago or New York or, Vegas, some of the areas that we've heard of, even potentially Canada. Canada Robotaxi app has opened up. They don't have any operations in Canada. It seems kind of pointless to launch the Robotaxi, app in Canada if you're not going to offer anything. So maybe that's coming soon. And I do think we're going to be surprised with some good news on that front in relatively short order. Okay. So I think all of this comes together as kind of a perfect storm for Tesla into the end of this year. Again, just my view. Could I be wrong here? Of course. But I see $500 as a likely next evolution for Tesla stock into the end of this year. That would put it past its, post-election highs on December 18th of $488 per share. Things are going to move fast, I believe, into the end of this year. Even if you look at the technicals on Tesla, they look really good. It looks like Tesla wants a leg into the 400s literally any time. And if the jobs report on Friday wasn't enough to get us, really fearful in markets, I don't think anything else is going to be in September. Unless, of course, we're, surprised with some kind of bad news. But again, to me, that seems unlikely at this point. So let me know your thoughts on this down below in the comment section. Hit that like button as well as subscribe to the channel. Let me know your thoughts. If you're confused, have questions, any of that, come check out the link down below in the description of this video for the trading community. Come chat with us 24/7. Come get involved with what we are doing over there and the projects that we are exploiting. So have a great rest of your day, and I will see you in the next one.